Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Miller Industries, Inc. Annual Report. Miller Industries, Inc. offers a wide range of businesses and services that cater to the towing and recovery industry. The company's primary products include wreckers for recovering and towing disabled vehicles, car carriers with hydraulic tilt mechanisms for transporting new or disabled vehicles, and transport trailers for moving multiple vehicles. The company markets its products under various brand names, including Century, Vulcan, Chevron, Holmes, Challenger, Champion, Jige, Boniface, Omar's, Titan, and Eagle. These products are sold through independent distributors in North America, Canada, Mexico, and to governmental entities through prime contractors. In addition to manufacturing and selling towing and recovery equipment, Miller Industries also provides services that support the transportation of vehicles. The company's products are used by various industries, including auto auctions, car dealerships, leasing companies, and other similar operations. Overall, Miller Industries is a leading provider of towing and recovery solutions in North America. Der Actionkurs von Miller Industries Inc. TN hat in den letzten 12 Monaten kein significant Veränderungen erfahren. Es ist schwierig, einlass der Arena zu erstellen, die dies Entwicklung verursacht haben, die Suchergebnis in der Regel bemerkenswert Auswirkungen hervorheben und nicht des Fehlen einer solchen Auswirkung quantifizieren. Eine der wichtigsten Nachrichten eines im Zusammenhang mit Miller Industries Inc. MLR, im Zeitraum von März 2025 bis März 2026 sind. Die Ankündigung der Ergebnis für das Quartal und des Gesamtjahr 2025 vor. März 2026, bei denen des Unternehmen die Erwartungen der Analysten übertroffen hat. Die Acquisition von Omar's SPA, einem italienischen Hersteller von Bergefahrzeugen, 10 europäische Präsenz zu erweitern. Die Genehmigung des Bau einer neuen Produktionsanlage in Ultua, Tennessee, die voraussichtlich $100 million kosten wird, und die Produktionskapazität erheblich erweitern soll. Die Erhöhung der Dividend 5% auf $21 pro Aktie. Die militärischen Auftragszusagen von über $150 million für das Jahr 2027. Diese reines haben zur Auswirkungen auf den Aktienkurs gehabt, aber nicht in dem Maß, dass sie die Schwelle von 499% überschritten haben. Es ist jedoch wichtig zu beachten, dass ein detailliert Analyse der Auswirkungen jedes einzelnen dieser Ereignis auf den Aktienkurs speziell finanzielle Tools und historische Kursdaten erfordern würde. Insgesamt kann man sagen, dass die Nachrichten eines im Zusammenhang mit Miller Industries Inc. TN, im letzten Jahr zur Auswirkungen auf den Aktienkurs hatten, aber nicht in dem Maß, dass sie die Schwelle von 499% überschritten haben. Miller Industries, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Miller Industries, Inc. trades at a higher price-to-earnings ratio of 19 times and a lower price-to-book ratio of 1.29 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On one hand, revenue growth is driven by increased production capacity due to investments in robotics and automated material handling equipment, expansion of domestic and foreign manufacturing facilities, and a strengthened supply chain through strategic investment. Additionally, the ability to pass on increased costs to customers can lead to price increases, potentially driving revenue growth. However, there are also several factors that contribute to revenue decline. Reduced retail sales and lower order intake due to high cost of equipment ownership, escalating insurance costs, and tariffs have led to a decline in revenue. Regulations with near-zero emission standards limiting the number of diesel-powered commercial vehicles that can be registered have also had a negative impact on revenue. Furthermore, ongoing challenges such as supply chain disruptions, inflationary pressures, and uncertainty around tariffs have contributed to revenue decline. The decrease in net sales due to lower production levels to mitigate inventory buildup in distribution channels has also been a significant factor. Ultimately, the primary drivers of revenue growth or decline are influenced by a complex interplay of factors, including investments, regulations, supply chain disruptions, and customer demand. The financial performance of the company underwent significant changes between 2023 and 2025. Net income decreased by 63.8% from $63,494,000 to $23,014,000, indicating a substantial decline in earnings. This decrease was also reflected in profit margins, with gross profit margin decreasing from 13.6% to 15.2%, operating profit margin dropping from 6.4% to 3.9%, and net income margin falling from 5% to 2.9%. The reasons behind these changes are multifaceted. Supply chain disruptions and inventory buildup, rising costs of equipment ownership, increased labor costs and skilled labor shortages, and disruptions to trade and supply chains due to military conflicts, tariffs, and Brexit all contributed to the decline in net income and profit margins. Additionally, a decrease in net sales and an increase in operating expenses as a percentage of sales further exacerbated the situation. The cumulative effect of these factors resulted in a significant reduction in net income and profit margins over the two-year period. The company's financial performance was severely impacted by external factors, highlighting the need for strategic planning and adaptation to mitigate such risks in the future. The company's financial performance has shown significant improvement in terms of generating positive operating cash flow. A notable increase of 485.2% was observed from 2024 to 2025, with the value rising from $16,870,000 to a substantial $98,720,000. This substantial growth indicates that the company is efficiently managing its operations and generating sufficient cash to cover its expenses, resulting in a positive operating cash flow. The company's debt level has undergone a significant transformation in recent years. As of December 31, 2025, the debt stood at $30 million, which is a decrease of 54% from the same period in 2024. However, this figure dropped even further to $20 million by February 27, 2026, after additional payments totaling $10 million were made. This reduction in debt has had a substantial impact on the company's interest expenses. The net interest expense for fiscal year 2025 was $660,000, representing an 83.2% decrease from the previous year's figure of $3,928,000. This significant drop in interest expenses is a direct result of the reduction in debt levels. The performance of various segments and regions within the company has been mixed, with some showing significant improvement while others have struggled. In North America, the company experienced a decline in net sales, decreasing by 43.3% in 2025 compared to the previous year. Additionally, total assets also decreased by 3.7%. This indicates that the region is facing challenges and may require attention from management to improve performance. On the other hand, the foreign segment has shown significant growth, with an increase of 18.2% in net sales in 2025 compared to 2024. Furthermore, total assets in this region increased by a substantial 169.1%. This suggests that the company's international operations are thriving and may be a key area for future growth. The consolidated performance of the company also paints a concerning picture, with a decrease of 63.7% in net income in 2025 compared to the previous year. This decline highlights the need for management to address the underlying issues affecting the company's overall performance. Management's outlook for the company is optimistic despite current challenges. They believe that continued compliance with government regulations will not have a significant impact on operations, and are hopeful that customer demand will increase as regulations ease in 2026. The company is investing heavily in robotics and automated material handling equipment to improve manufacturing efficiency and flexibility. This investment is expected to pay off in the long term, despite current supply chain constraints and inflationary pressures that may affect profitability. Management is also focused on expanding the company's footprint through strategic acquisitions, such as the recent purchase of Omar's, which will provide additional capacity and help meet growing customer demands. The acquisition will also improve manufacturing flexibility and allow the company to enter new markets outside of the United States. In addition to these initiatives, management is committed to ongoing capital investments in manufacturing facilities and other assets to increase production capacity and efficiency. They are also continually monitoring working capital to support operations and pursue growth opportunities. Overall, management's strategy is focused on investing in technology and expanding the company's footprint through strategic acquisitions, while navigating current challenges such as supply chain constraints and inflationary pressures. The company has a history of rewarding its shareholders through dividend payments and share buybacks. In terms of dividends, the company has paid out $0.20 per share, with a total payment of $9.2 million in 2025. This indicates that the company is committed to returning value to its investors. In addition to paying dividends, the company has also engaged in share buybacks. In 2025, it repurchased a total of 204,054 shares for $6 million. This demonstrates the company's confidence in its financial position and its desire to reduce the number of outstanding shares on the market. Inventory buildup is a pressing concern for businesses. The data reveals that inventories have been increasing over the years, with a notable rise of $18,915 in 2025 compared to a decrease of $30,421 in 2023. Furthermore, inventory levels increased from $186,169,000 in 2024 to $184,231,000 in 2025, indicating a trend of accumulation. While there are concerns about inventory buildup, the data on supply chain disruption is limited. However, it is worth noting that supply chain disruptions and supplier shortages have caused delays in shipping, freight cost increases, and affected production capabilities. This suggests that businesses may be facing challenges in managing their supply chains effectively. That concludes the financial summary for Miller Industries, Inc. Feel free to comment below, and I will be happy to answer them when possible.